Hey guys, how's it going? Solo back with another daily video, and I wanted to do something a little bit differently today. It was just about a year ago that I made my first tutorial video on the wheel strategy, and that video is still my most popular video on my channel. So I thought it was due for a 2021 update, and honestly, I want to make that video even better because that was one of my earlier videos and it's a little bit cringy. So let's talk about the wheel strategy, and this is going to be a tutorial. If you're not familiar with what the wheel strategy is, I'm going to walk you through it step by step on Robinhood to show you exactly how you can run the wheel on any ticker that you want. So for this example, we're going to use Marathon Patent Group, or ticker symbol MARA, M-A-R-A, just because it's been hot in the market lately. It has very juicy premiums, so you can make a lot of money running the wheel on this. Now, the key is when you first pick a stock, in my opinion, you want to pick a stock that you would not mind owning shares of. Meaning, my strategy is I like to pick stocks that I like long term, because if you get assigned shares of this stock, then I would not mind having to hold this for maybe weeks or months or maybe even years if I have to. Some people like other strategies where they don't care about the specific stock as much, and they just look for the juiciest premiums every week or every month, depending on how long they like to run the expirations on their options. There's more than one way to wheel stocks, so there's no one right answer, but let's get right into it. So what is the wheel strategy? So the wheel strategy is an options trading strategy. It's a function of Theta gang, if you've heard that term before, where you basically use time decay, or you use time to your advantage, meaning every second or every minute or every hour or every day, you slowly earn money with your option. And that's what the theta of Theta gang is. Theta is time. So let's just get right into it. Let's say you chose your stock. In this example, I chose Marathon Patent Group. So the first thing you're going to do on Robinhood is go to the options chain right here where it says Trade MARA Options. Now, if you don't have options enabled, you want to go up here to the right and go to Account and enable options trading on Robinhood, and then this box will show up. You're going to click this, and then you're going to be taken to what's called the options chain. So there's a couple things you want to see here. You see here on the top, you have buy and sell, then you have calls and puts, and then you have the expiration dates. You can see MARA has monthly expirations, so January, February, March, June, and then even January of next year. Some options will have every week will have an expiration date. So every single week you have a new expiration date. So there's more expirations you can trade. We can get more in depth about the strategy I use to pick stocks, or the strategy I use to pick strike prices and expiration dates in later videos. So make sure you subscribe for when those videos come out. But just as a quick and dirty example, with the wheel strategy, you're always selling options. You're never buying options. So you always want to make sure you have your sell box here highlighted. And then the first step in the wheel strategy is to sell a put. Okay, so I'm going to write that down here on the side so we can just kind of keep track as we go through the video. So the first step is to sell a put option. So this is key because you want to make sure you have the right setting on Robinhood. You want to have sell and put. Okay, so then you can see the option chain changed a little bit. Some of the values changed a little bit, but that's fine. Now, the first thing you want to do when you want to look at the premium values is you want to calculate, what I like to do is to calculate the return on risk. What that means is all these values here on the right side are the premium values. So for every share of this stock, I'm going to collect, for example, if I chose this option here, $5.33 every share. But every contract, when you're trading options, every contract is always 100 shares. You have to multiply this number by 100. So obviously $5.33 times 100 is $533. And again, this strike price is $28 per share. So you also have to multiply this by 100. So this is going to be $2,800. So if I want to sell one contract of this option, so if I want to sell, just do, let's say, one of these, then I'm going to need $2,800 in capital. So I'm going to need at least $2,800 in my account in case I have to buy 100 shares of this stock for $28 a share. Okay. Now, what's your reward? Well, my reward, if this stock stays above $28 on this expiration date, then I get to keep all this money for free. And I don't get assigned any shares. I don't have to buy any shares of stock. So that's what happens when you sell a put. You're basically saying you pick a strike price that you think the stock will stay above by this day on end of day. So on January 14th, for example, Mara could be $25. And you're like, uh-oh, it's below my strike price, so I'm going to have to buy 100 shares of Mara at $28. But if the next day, on January 15th, the date expires by 4 p.m. Eastern time, let's say Mara has a good day and it goes all the way up to $30, you're good. This strike price is lower than the share price on the end of the day, on the day of expiration. So basically, you need your stock to close the stock market trading day at 4 p.m. Eastern time on your day of expiration above whatever your strike price is. And I hope that makes sense. And if that happens, you get to collect all of your premium, which in this case would be $533, for free. Basically, you win, right? However, even if, let's say, Mara closes at $26 on January 15th, and now you have to buy 100 shares of the stock at $28 because that's what you agreed to when you sold the option, you still get to keep the premium value, okay? So you have to buy the stock, but you still get to keep the full premium. So yes, it's not ideal, but you still made a little bit of money. You got a little bit of cash flow. So that's your first step, is to sell the put. Now, the best case scenario is Mara, or whatever stock you pick, stays above your strike price when your option expires, and you just collect free money. And then you can pick another stock the next week, or do the same stock, or pick another option next week. You're just basically collecting money until, or if eventually one day you get shares of stock assigned to you. Meaning, let's say, January 15th rolls around and Mara closed the day at $30. Fantastic. I get to keep my $533 free and clear, and I don't get assigned any shares of stock. So that was a great option trade, and I made good money without any risk. But now let's say I want to do another option. I'm still on step one. I'm still selling more puts. So then the next time, let's say I go to February 19th now, and I want to sell another option. So let me try the $27 strike this time. So again, this time I'm going to need $2,700 in collateral because it's times 100. And my payout, this is not accurate. I'm just using this as an example, but my payout would be $888, okay? But let's say this time, unfortunately, on February 19th, Mara closed at $24 a share. So we are below my strike price, which is not good. I get to keep still my $888, but I now own 100 shares of Mara, and I had to buy them at $27 a share. So it kind of stinks because I bought 100 shares of Mara at $27, and in my example, it's trading for $24 right now. But if I didn't sell this option and I just wanted to own the stock, I could have bought it cheaper. That's kind of the gamble with options trading. But you're okay because now you own 100 shares of stock and you collected your premium. You got max profit still. So now the next step in the wheel strategy, after you sell your put, if you get assigned shares of stock like we did in this example, now you're going to sell some what they call covered calls. So I'm going to write this down here, covered calls. And this is the same thing as a call option. The reason why it's called covered is because you own the 100 shares of the stock. So that's what's covering your call option. So now, instead of on the put side of things, I'm going to delete this. We are going to switch over because now we own 100 shares of the stock. We're going to we always sell. We never buy options with the wheel strategy. It's always a sell. Now we're going to switch over to the call side. So now we're going to sell a call. And now, so like I said, in our example, you own 100 shares of Mara at $27 a share. So I'm just going to write that here on the side. Okay. So your cost basis is not actually $27 per share. Your cost basis is actually $27 minus the premium that you collected. If I just go back really quickly, in our example, we said we collected $888 or $8.88 per share. So really, your cost basis is $27 per share is what you paid for it, but you collected $8.88 per share in premium. So if we subtract the two, your cost basis is actually only $18.12, okay? Because you got that premium even though you have to pay for the shares. So now what we want to do is we need to sell covered calls, and we're going to keep making money this way. So this is important because essentially you paid $18.12 per share times 100 shares. So what you want to do is to keep making profit and be overall profitable on the trade. Keep selling covered calls at strike prices that are above your cost basis. So what I can do is, let's say in our example, I said Mara was trading right now at $24, okay? So $24 is above $18.12. So really, I can sell calls 19, 20, 21, 22, 23, 24, 25, whatever you want, however high you want to go, above $18. Now, here's the strategy here. The higher you go above your cost basis, like let's say I want to go to $28, what's going to happen is your premium value is going to go down, meaning you're not going to collect a lot of premium because it's so far away from your cost basis or the share price. But if that stock gets to your strike price, you're going to collect a lot of stock appreciation, because what that means, if we sell this call, is that you only paid $18.12 per share. But by selling the call, you're agreeing to sell your shares at whatever strike price you chose. So let's say I chose $28. Let's say I want to sell this covered call at $28. So I'm still going to collect $7.93 per share, or $793 in max profit to sell this covered call. And let's say Mara on February 19th, for example, or the day of expiration, gets to $29. Well, then I agreed to sell my shares at $28. I only paid around $18. So I'm making almost $10 a share in stock appreciation. Remember, and that's times 100 shares. So $10 a share times 100 shares, that's $1,000. So if Mara then rockets up above my strike price, I make the stock appreciation, which is about $1,000, plus all this premium I collected by selling the option. So if that's the case, and then your shares get called away now, you've basically completed one full turn of the wheel strategy. So that's why it's called the wheel, because you just keep going around and around. Step one is to sell the put, like we did. Keep selling the put until one day you actually get assigned shares of the stock. Step two then is to keep selling the covered calls until one day your shares get called away. And that's why it's called the wheel strategy, because you can just keep going round and round and round. So that's basically the mechanics of how the wheel strategy works. Leave me a comment below if you have any questions. If you like these types of videos, give me a like and subscribe, and then let me know in the comments below so I can keep making more of these tutorial type videos. And also join our Discord server. We have a lot of smart and friendly people in there. So if you want more real-time answers, we're more than happy to help you in there. As always, follow me on Twitter, follow me on Reddit, follow me on Instagram, follow me on StockTwits, and I hope you have a green trading day.